I have a sense that because people are misunderstanding what will happen to them, and because they have a false sense of confidence, that the erosion of confidence won't happen gradually, but rather will happen precipitously. Specifically, I'm afraid of a credit event like the credit event that occurred in 2008. I'm not certain this will happen, but I'm afraid it'll happen.
Rick Rule expresses concern about a potential financial crisis, drawing parallels to the 2008 credit event. He specifically fears the vulnerability of subprime commercial loans, emphasizing the risks associated with illiquid underlying assets in junk debt ETFs. Highlighting the lack of investor knowledge about credit quality, he warns of a scenario where selling these ETFs could trigger a liquidity crunch, similar to the 2008 experience. The greater worry is the government's limited capacity for fiscal stimulus, given the substantial on- and off-balance sheet liabilities, surpassing $120 trillion. While he doesn't guarantee a crisis, Rule believes there's a probability of a credit-inspired liquidity crunch, underscoring the need for cautious financial management. Let's dive into the video to hear his full thesis.
And the place that it scares me the most is in the subprime credits. Commercial mortgages on second-tier real estate. Side note, I was in New York City not too long ago. I was in a second-tier building, Midtown. The building was 16% occupied.
Yeah.
The building can't service the operating expenses and the property tax, let alone the mortgage. But what scares me more in the commercial sense is subprime commercial loans, which is to say junk debt. There are between $2 and $3 trillion in junk debt ETFs in the United States and Europe. Investors that are chasing yield, but they're sacrificing credit quality.
Right.
That in itself is scary enough because the people who are investing in this stuff don't know anything about credit. They're just chasing yield. But what scares me more is the sort of structure of these products. These ETFs are hugely liquid. They trade billions and billions and billions of dollars a day in $5,000, $10,000, $20,000 units. But the underlying assets that they own are completely illiquid. They are over-the-counter traded bonds very often from subpar credits. And if we hit a point in time where there is a question about credit quality, which there should be, much as there was a question about the credit quality around the real estate market in the United States in 2008, I think you'll have a circumstance, or you could have a circumstance, where people begin to sell these ETFs. When they sell the ETFs, the managers have to sell the underlying asset to redeem the cash. There was a saying when the junk bond market collapsed the last time, the Drexel-Burnham collapse.
Michael Milken,
and they described these illiquid bonds as owl bonds. Your guy from Morgan Stanley will know what that means. An owl bond is when you call your broker and say, please sell this bond. And he says, to-hoo. This circumstance where people sell the ETFs and the managers go to sell the bonds, but there's nobody to sell the bond to. A recipe for the replication of what we experienced in 2008. The problem with that, well, that's a problem in and of itself. But a much larger problem is that the government itself has much less rope to push than they had in 2008. The on-balance sheet obligations of the U.S. government now exceed GDP, which is to say the U.S. government owes $33 trillion on balance sheet. Admittedly, only 26 trillion after the Fed's own balance sheet, which is to say after quantitative easing, or more properly, counterfeiting.
Yes.
But a bigger problem is the off-balance sheet liabilities, the net present value of entitlements, Medicare, Medicaid, Social Security, which is to say old, fat, bald guys like me. That number in the United States exceeds $120 trillion by the estimates of the Congressional Budget Office, which is to say our government is much more illiquid and much more encumbered now than in 2008. So the ability to afford fiscal stimulus is much lower. So I'm afraid of a crisis in confidence, sparking a credit crisis, sponsoring a liquidity crisis without the government's ability to spend, print, and borrow our way out of it. Do I know this is going to happen? No. Do I think it's going to happen? Unfortunately, I actually do think it's going to happen. I think that there is a probability rather than a possibility that we will have a credit-inspired liquidity crunch at some point in time. We're going to get through it.
In this next discussion, Rick Rule emphasizes that a bear market doesn't necessarily destroy wealth, but rather shifts ownership from weak to strong hands. He cautions listeners about the need to choose between being in the stupid weak camp or the strong smart camp, predicting that more people will unfortunately fall into the former. He suggests that signs of this shift are already visible, and while it won't be the end of the world, over-leveraged portfolios may face challenges in the coming years. Rule urges individual investors to adapt to a changing landscape, advising a shift towards a value perspective and emphasizing the importance of getting personal balance sheets in order. He dismisses the notion of relying on government intervention to fix economic challenges and encourages a proactive approach to navigate the evolving financial environment.
A bear market doesn't destroy wealth. If the price of a house falls in half, the value of the house doesn't change, but the ownership changes.
Right.
It goes from weak, stupid hands to strong, smart hands. Now, the weak, stupid hands don't like that a bit, you know, and it's going to be up to your listeners which camp they inhabit, the weak, stupid camp or the strong, smart camp. And unfortunately, more people will inhabit the stupid, weak camp, and they will be very resentful. I think the signs are already there. It doesn't have to happen. And by the way, this isn't going to be the end of the world, but it is going to be the end of marginal over-leveraged portfolios. So, although humankind will get through this, I hope, without wars,
yes,
individual investors, I think the next 10 years are going to be a lot less benign than the last 40 have been. And I think that people who are looking at the world through the lens of the last 40 years need to begin to shift the lens a little bit. I don't think that people should be so defensive that they crawl in the corner and curl up in fetal position and whimper and moan. I just think that people need to invest from a value perspective, and people need to get their personal balance sheets in shape, because the government balance sheet is not going to get in shape. You can't trust the big thinkers. You can't send mommy to Washington and have her to kiss this and make it better. It ain't going to happen.
In today's insightful discussion, Rick Rule raises critical concerns about a potential financial crisis, particularly in subprime credits and junk debt ETFs. He emphasizes the importance of recognizing the signs and encourages a shift towards value-based investing. As we navigate these uncertainties, remember, a bear market doesn't destroy wealth, but shifts ownership. Are you in the weak, stupid camp or the strong, smart camp? Share your thoughts in the comments below.